Buying a mall sounds simple. Fill an empty building with stores and collect rent forever. In reality, it's one of the strangest business models in real estate. Part 1. The cost of getting in. Building a large regional mall from scratch, land, parking structures, plumbing, electrical, climate control, permits, can easily cost several $100 million before a single store opens. Buying an existing mall is usually cheaper, but not all malls are equal. Class A malls have luxury anchors, high sales per square foot, and waitlists of brands wanting in. These can sell for over $1 billion. Lower-tier malls tell a very different story. Rolling Acres Mall in Akron, Ohio, once sold for over $33 million, then later changed hands for just $2.75 million, and eventually sold again for under $2 million as it kept losing tenants. The purchase price of a mall is really a bet on the surrounding neighborhood's future. Most large malls today are owned by real estate investment trusts, REITs, companies that must pay out nearly all their profits to shareholders in exchange for skipping corporate income tax. This lets ordinary investors own a slice of mall income without dealing with a leaking roof, and lets big REITs spread risk across dozens or hundreds of properties, unlike a private owner betting everything on one building. Part 2. Hidden costs you inherit. New owners get blindsided by a few things right away. Old anchor leases. Department stores often signed rent deals decades ago, and you're stuck with them for years. Deferred maintenance. Roofs. HVAC systems covering 1 million+ square feet. Cracked parking lots. Problems the previous owner may have papered over. Co-tenancy clauses. Buried in most leases, these let smaller tenants pay reduced rent, or leave entirely if a major anchor closes. The mall can look fully leased on closing day, and then one anchor's exit quietly unravels the whole financial structure. Part 3. 4 ways a mall actually earns money. Base rent. Charged per square foot per year. Small specialty stores might pay $40, $60 per square foot in a strong mall, while anchor department stores, before Sears collapse, were often paying closer to $5 per square foot. The anchor isn't paying for space, it's paying for its name and the foot traffic it pulls in, and every smaller store is effectively subsidizing that discount. 2. Percentage rent. Once a store's annual sales cross an agreed breakpoint, the mall takes a cut, often around 6 to 7%, of everything sold above that line. Income that rises automatically when the mall performs well. 3. Common area maintenance, CM, fees. Tenants split the cost of cleaning, lighting, security, and parking lot upkeep based on how much space they lease. If shared costs total $250,000 a year and a tenant occupies 10% of the mall, they owe $25,000. 4. Everything else. Parking fees, digital ad screens, kiosks, pop-up events, and holiday markets. Oddly, a tiny kiosk, under 100 square feet, sitting in a high-traffic walkway can charge more per square foot than a full storefront, because in this business, position beats size. Part 4. The expense side. Running a mall is expensive. Utilities for over 1 million square feet of climate-controlled space, security, cleaning, landscaping, snow removal, property taxes, and rising insurance costs. One detail trips up new owners. CM costs don't shrink when stores sit vacant. Hallways still get cleaned, empty storefronts still need lighting, security still patrols the whole building. So rising vacancy pushes CM bills higher for the remaining tenants, which can push marginal stores to leave too, accelerating the decline. There's also a trap hiding behind occupancy rates. A mall can look 90% full and still be in serious trouble if much of that space is anchors paying almost nothing or short-term discounted leases just keeping the lights on. Occupancy isn't the same as income. Part 5. Why malls are built the way they are. Developer Alfred Taubman is widely credited with engineering the modern mall's layout. He spaced anchor stores roughly 3 city blocks apart, so shoppers walking between them passed dozens of smaller shops. He placed escalators at the ends of corridors, not the middle, forcing longer walks. He mixed skylights with artificial lighting, so shoppers lost track of time. Every design choice existed to maximize how much storefront a shopper's eyes crossed, because that exposure is what smaller tenants are really paying for. Part 6. The anchor collapse. For most of the 20th century, department stores like Sears were the reason malls got built at all. Banks wouldn't finance construction without an anchor locked in. That changed fast starting in the 2000s. Sears, once the country's largest retailer with roughly 4,000 stores at its peak, filed for bankruptcy in October 2018. Roughly 80% of its stores sat inside regional malls, and some major mall owners had Sears in dozens of their properties. Because of co-tenancy clauses, a single anchor closing could trigger rent cuts or lease exits across dozens of smaller tenants at once. And refilling a vacant anchor box isn't quick or cheap. These spaces often exceed 100,000 square feet with loading docks built for one specific kind of tenant. One mall owner reportedly spent $100 million over 3 years just to split a single former department store into 4 smaller units. Multiply that across dozens of empty anchors closing simultaneously, and the damage compounds for years. Part 7. Rolling Acres, a mall's full life cycle. Rolling Acres Mall opened in Akron in 1975 with Sears as its anchor. It grew to over 140 stores with 5 department store anchors, a theater, and a food court, and by the mid-1990s was reportedly about 98% occupied. Then the anchors left one by one. A newer competing mall opened nearby, Target relocated, Dillard's closed, another anchor rebranded twice before shutting down. By 2006, the mall sold for $1.6 million, a fraction of its former value. The interior closed in 2008. Sears held on until 2011. The last tenant, a JCPenney outlet, closed at the end of 2013. What followed was worse than empty storefronts. Scrappers stripped copper wiring. One person died attempting to steal it. Vandals shattered skylights, letting rain and snow rot the structure for years. The city eventually seized the property after owners stopped paying over $1 million in back taxes. The building was demolished between 2016 and 2019, and Amazon later built a distribution center on the land. Part 8. The Bigger Shift. The Sears collapse coincided with online shopping eating into retail spending nationwide. A mall's core value had always been convenience, comparing many brands in one trip. E-commerce erased that advantage. Shoppers can now compare endless options from home and get delivery in a day or 2. Malls stuck in the middle, not upscale enough to sell an experience, not cheap enough to compete on price, got hit hardest, especially ones already in declining areas. Meanwhile, surviving malls adapted by leasing space to things a screen can't replace. Restaurants, gyms, urgent care clinics, co-working space, entertainment venues, even converting old anchor boxes into apartments or hotels. Rolling Acres was 98% occupied at its peak. It took less than 20 years to go from full to rubble, not because of one disaster, but a chain of smaller failures, each making the next one more likely.